Hello, fellow traders. 'Tis I, the Rumpled One. A few traders from StockFetcher have asked me to talk about some of my work over there because I know most of my trading videos have been geared toward foreign exchange, the currency trades. My examples are usually about currencies, and I guess my stock trading friends feel abandoned. So I'm going to rectify that today. So we're going to talk about the buy zone, aka also known as milking the cows. Now this is something I developed and started publishing back in 2008, and it still works today. It's a very simple system based on a very simple idea. Um, I used to make a joke that, I'm just a, simple trader. And, I really don't know that much about trading, but I know that the high is usually higher than the open and the low is usually lower than the open. So I figure that if I buy somewhere near the open at or near the open price, that sometime during the day I can sell it for more than I paid for it. And that's all I know. Well, anyway, that's my accent. But even though, I kind of joke about it, that's how simple this is if you look at how a stock ranges, its daily trading range from open to high and then open to low, and you run a frequency distribution on it, you'll see just how simple it is to make money using the buy zone or milking the cows. Now, the reason I call it milking the cows is because I live on the West Coast, been on Pacific time. So I'm 3 hours behind New York. So when New York opens at 9:30 in the morning, it's 6:30 here, and so I have to be up a little before 6:30 to take advantage, and that means I got to get up with the dairy farmers when they go to milk the cows. Now, one thing that most traders do that they don't understand works against them is they try to fit the method to the instrument they're trading rather than the other way around. What I mean by that is simply in the buy zone method, you want to find the stocks that work best with that method, as opposing to using that method on every stock in the universe. It doesn't work that way. You will fail. And that's why many traders fail, because they fail to find the best instruments for the method they use, because they don't use statistical analysis. And most forums, most people, most traders you talk to, they don't use it, and that's why they're not successful. So let's take a look at StockFetcher. Now, I wrote many filters, but this one simple filter I call the MTC, or Milk the Cow Checker. It'll tell you whether or not the stock you're considering trading is a cow. And so you see we have the high minus open, and then what we do is we count how many times high minus open was above 9 over the last 100 days. And then we say up 50. We count how many times the high minus open was up over 49 cents the past 100 days. So in other words, we're looking between a dime and 50 cents. And then what we want to see is we want to see the percentage of 50s over the 10. And stock at the time when I posted this was Lulu. But what you can do, StockFetcher traders or people on StockFetcher, you can copy this filter into your filters, and in the sim list, you can put whatever stocks you want. Like I said, we have Lulu. And you can see over the last 100 days, it was up 10 cents or more 87% of the time. And it went up 47, went above 50 cents high minus open, over 47 days out of the last 100. So the trigger is price must reach open plus 10. And you want to enter the trade somewhere between open plus 10 and open plus 20. That's 10 cents and 20 cents. And if you do that, and then the stock continues to go up to 50, that's when you start taking your profit. But you see here, it only went up 47 times. It's not really a cow. If we look over here, this is a stock fetcher filter that gives me all the cows. And I even have it broken down further. Between 0 and 9 cents, if it doesn't hit 10, it's not a trade, so you can throw that column out. Between 10 and 19, you can call these losers because they didn't go past the 20. They got to the zone, they entered the zone, but they failed to go past the zone. You can see here, then 20 to 29 cents, 30 to 39, 40 to 49, 50 to 99 cents, and then how many times did it go $1 or more? How many times did it go 50 cents or more? And you can see these high dollar stocks just really crush it. But we can find something like this Salex Pharmaceuticals. You can see here, it went up 83 days out of the last 150 cents or more, and out of those 83, 70 was $1 or more. So every morning when the open bell sounds, you can sit there on your platform, have your horizontal line set at the open, another one set at open plus 10, and a third one set at open plus 20, and milk this cow called SLXP every day. And if you did that, you'd see here there was one day you didn't trade, 3 days you had a loser, a few days you barely made anything, but once again, 70 days you could have made $1. If you were just trading a lousy 100 shares, 70 times 100, that's 7 grand. Now, you might say, well, geez, I don't have that kind of buying power. Well, let's look at Solar 60. Solar City, it's a $64 stock. It's up, once again, 100, $1, 67 times out of the last 100 days. 50 cents or more, 87 times. You could have had 4 losers. Actually, 4 you didn't trade, a loser, little bit of money, but as you can see, this frequency distribution is tilted over to the 50 or more. It's very, very, very simple to understand. You see 50 to 99 and $1 or more. So these types of stocks can pay off really nice. And here's another one, Fire Eye Inc. Never even heard of that. 5 days you didn't trade, and 6 days out of 100, you call it a loser if you want. But the rest, you can see here, 50 days, you would have made $1 or more. That's 50 times $1 on 100 shares. Do the math. 76 days, you could have made 50 cents or more. So depending on how quote-unquote greedy you are, you can see how profitable this method is. Now, why does it work? It simply works because the difference between open plus 10 and open plus 20 is only 20 cents. But these stocks range a lot more. Right here, high to open, $1.55. This one, BIIB, didn't even get off the ground, but if you were a shorter, it went down $11.28 because the buy zone, if you're a shorter or a plunger, like my good buddy Wild Super up in Canada, likes the short stocks, you can see here, it also works the opposite way. I have a different filter that does it for the shorts, but it works with the same frequency distribution idea. Now, along with this, I also wrote a filter called Fading the Gap Statistics. And we'll get into that on another video. But for now, we'll just focus on the buy zone or milking the cows. So once again, to be a cow, what you really want is you want the high minus open to be 50 cents or more about 80 days out of the last 100. So anything that's less than 80 doesn't work. And like I said, you can just add some stocks here. We could do Apple, let's see, Google. I can't even think of anything else. Let's see if I can think of something. Let's just do Caterpillar. And then it says fetch stocks. We run the scan. And you can see here, none of these are really cows. But if you go back over here, let's see, Netflix, Z, BIIB. You can put them here, fetch the stocks, and you can see here, 91. Now for some, oh, I didn't spell Netflix right. Typo. So you can see here, up 50, 91 times. That's 50 cents or more from the open, 92 times, 88. So once again, it's a very simple strategy. It works. It's been proven for, let's see, this is 2014, 5, 6 years. It still works. It will work 50 years from now unless there's no market, because these stocks have to range. They're going to go up so much, they're going to go down so much. They have to range. And when they range, they have to cut through the buy zone. So once again, when they cut through the buy zone, that's your opportunity to enter the trade, take the money off the table, milk the cow. Graphically, you can see here, this is a currency chart, but we've got the buy zone set here, the short zone set here. And once again, you can find this out on my Never Lose Again thread on Stock Fetcher. Fellow traders, I hope that helped. And as always, I've said it before and I'll say it again. It's not what you trade, it's how you trade it. The Rumpled One signing off.